With what's happened in the 35 plus states in America, with the first wave hitting them, earnings season is no longer the given that we thought it might be, because supply chains are interrupted, as we've talked about. The earnings that they were counting on are going to change. Unemployment took another turn for the worse, where you have 1.5 million more people on that. So earnings season, it's not cast in doubt. However, it has gone from being a little bit more certain to a lot less so. And we have to keep that in mind. Although you have the big names that are historically have done well, now you have some brand new names who are have done well, but during this pandemic are doing even better. You know, we talked about Zoom that we're using right now, and a lot more people are still using it. And we're going to see, you know, in the next quarter, how many more subscribers they've gained because of that. You know, traders have to take profits at some point. Maybe some of them have ridden this stock 20 to 50 points just in the last year alone. And this would be a great opportunity. Take some of that off the table. If the stock goes down further, they can go buy it again. And that could be a nice move for them on the upside. Also, you have to remember, by taking profits at this time, there are also other opportunities that traders and investors are looking to go into. And I think that's it says a lot about this market, that that has been kind of a narrow field per se. And now it's broadening, that it's just not the Netflix, Zoom, Microsoft of the world, that it's broadening out. And we could see some really nice movements in other areas, whether it be consumer cyclicals, areas beside tech. And it's going to be interesting to see, especially now. Some people are taking profits and taking money out of the market to go into fixed income or to hoard cash, because we're seeing a lot of cash being hoarded right now in money markets and other instruments of that nature. But you're not really getting paid to do that. Most managers I know that, we're fighting inflation all the time. And you want to make sure that in the fight that you're not losing money to inflation. And one of the big things you have to keep in mind is, if I'm making less than 1%, I'm losing to inflation, and the time value of money erodes. And no money manager that I know wants to be stuck looking, on the outside looking in when that happens. So they're going to look for high quality that has not broadly participated in this market segment. And there's just a lot of names out there. Are we going back to where we're worried about inflation and we need to respond accordingly? Not only that, we also need to make money. And most investors I know, most portfolio managers I know, they are, as you mentioned, we're looking for undervalued securities or value plays. And in a time like this where growth stocks are taking off and moving on the upside, we also know that value tends to participate, albeit a little bit less, but it's a good play, just for argument's sake. So some people ask, well, what about value? Well, think, if IBM went down 10 points because of a non-fundamental, a news of the day or what have you, some traders will go and they'll buy that at a 10-point discount, right? We're looking for that in a constant, never-ending search, and we want to make sure that we're buying names that make sense. We're strategic about it. We're not going to put a ton of money into these value stocks, but we're going to definitely put enough of a percentage that we want to beat inflation. We want to make sure that these names go up and that we believe in these companies. So yeah, it is important, and yeah, we are starting to come back a little bit, but we're not there yet. That, people are skittish. They just say to themselves, I'm not going to go 100% just because I made a lot of money in one particular stock. Doesn't mean I'm going to take 100% of that and go into the next stock ideas or bond ideas. So what I'll do is I'll take let's take 60%. I'll put 40% in a cash or money market equivalent, and I'll put that 60% where I can have more conviction going into those value stocks or whatever stocks they decide to put in. And that way, it's kind of, they don't feel that they may get as burned if something goes in the opposite direction. And that's just a smarter, albeit more conservative play. Some managers are like that. I find that most managers are very comfortable staying 100% in the style that they are accustomed to. They know the market, they're very comfortable there, and they're looking to see, well, where's the next high fly grower? I have looked at, aside from tech, you can look at telecommunication companies, you could look at energy companies, if you're looking for solid dividends. You could also look at consumer goods right now. I've talked about Campbell soup and the like, but think about it. When you're stuck at home, what are the products that are you going to use? And we're seeing all these reopenings in all these states that are being paused. Look, in California, they stopped. Oregon, they stopped. Many different states are going to be doing the same exact thing. So you want to be in sectors that before the reopenings occurred, that we're saying to ourselves, I want to be in those sectors because of the pauses in the reopening, and I'm going to make money no matter what.